Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson, editor of WallStreetWindow.com. Welcome back to the show, Mike.
Oh, it's great to talk with you. It's a very interesting time. We have not spoken since those tit-tat attacks between the Trump administration and Iran happened last week, so interesting time to say the least.
What has that done to oil?
Well, I'm really interested to see what happens now because oil, of course, and gold, for that matter, both were going up Friday night and then the following Tuesday when Iran counterattacked against Trump, shooting rockets into that base in Iraq. Oil gapped up that evening. Gold went above 1,600, and both have since pulled back. And this, to me, could be a potentially interesting couple weeks. Because, in my view, gold started a bull market, or clearly did, last year when it went through $13.50 an ounce, and it's now pulling back, and when you get a pullback, that's ultimately a buying opportunity. And I use the 200-day moving average to gauge whether something's in a bull market or a bear market, and when you're in a bull market, that tends to act as support, prices stay above it, and when they come down to it, it's just a great buy. The S&P 500 has been like that now for 10 years. Has not spent more than 3 or 4 weeks below that 200-day moving average. Now, it's oil, though, to answer your question, that has my most interest at the moment because I've been bearish on oil and energy stocks for years, really since 2014, and I have not personally bought an energy stock in over 10 years until last week. And I did that not because of the news with the Middle East and Trump and Iran. I don't believe a serious war is coming and didn't think that I thought those events would die out, although I think, we'll see something, some sort of tensions increase in the coming months or a year or sometime. More of the same, but not a real war. But what's most interesting to me is what will oil do now? Because oil in September gapped up even more on a percentage basis when Iran's proxies struck that Saudi oil refinery. Oil gapped up that day, and so did the oil stocks. The XLE ETF, the most popular energy stock ETF, went to 60.5, but then fell straight back down. So within 2 weeks, it had plunged all the way down to 54, which was close to a 52-week low. The price of oil also went down to $51, from $63 all the way down to $51 after that refinery attack. And that's the type of action you see in a bear market. You see rallies that happen on news that would seem to justify higher prices that simply get sold. And that happens over and over and over again. And that's really been the story for oil. So here we are now, where oil once again gapped up and went up to a little bit over $65 for a brief moment approximately a week ago, and it's now at 58. So it has fallen for a couple of days. The XLE ETF, though, went to above 61 and is now trading around 59.5. That's a pullback, but not very much of a pullback. And there's many energy stocks that are trading right on that 200-day moving average. And some actually are above it. So, for example, BP Aramco is right on the 200-day moving average, but BP Prudhoe Bay Royalty Trust is above it. Most of the stocks are around it one way or the other, though. What's noteworthy to me, though, is that so far, the energy stocks, and the price of oil for that matter, even though they have come off that attack high, they are not collapsing or falling anywhere like they did in September after the oil refinery attack. And I believe if the stocks can hold here, or even go down just a little bit more, and then go up again through the highs made last week, that will be a sign that they're actually entering a a bull market. They're starting a new bull market, that they're leaving the bear market of the past couple years and entering a new bull market. And I don't think it will have anything to do with Middle East tensions, but simply a part of a larger commodity cycle. Historically, the way the commodity cycle works is gold and silver go up first, which they did last year. In fact, the GDX gold stock ETF went up 38% last year, where the S&P 500 went up around 27%. In other words, gold stocks were the best thing to basically be in, even though the stock market did well, and most people have no idea what in the United States what the gold stocks did. The fact of the matter is, they beat the market. And I was basically asking myself, before the attacks happened and as we approach the new year, what is likely to beat the market this year? Gold and silver suggest that it's commodities. So if energy stocks can go through the highs of last week, consolidate basically, and then break out again, let's say within the next 6 weeks, I think they're going to be a place we all want to be in. And there's many, many energy stocks, hundreds of them, and many of them pay big dividends. So I think that's an exciting opportunity. And also, other commodities have the potential to do the same thing. So one last thought before I turn it over to you. The agriculture commodities has also been an area I've been very interested in the past couple of years. Agriculture prices basically have been in a bear market also since 2012, with the prices going so low that they're at historic lows compared to the value of the dollar. And I've tried to buy them a couple of times and gotten stopped out, but there's a potential turn right there too. So since 2012, every single rally in the ETFs DBA and RGA, which are the biggest agriculture commodity ETFs, that have taken them up to the 200-day moving average, stalled out, and the ETFs would go lower within at least a month, or a month at the latest. And if they do end up pausing here and breaking out again, that also would be a sign of a major shift in the agriculture commodity world. So those are powerful trends, and I don't think these are just trades if they happen for a couple weeks, but for a couple years. Because I think what happened last year with the gold-silver breakout represented the start of a long commodity bull cycle that is likely to last through the rest of this new decade, the 2020s. And that's the same thing in a way that happened after the 2000 stock market top. Gold outperformed the Dow all the way to 2012, and oil and energy did very well from about 2002 to the summer 2012 also, and so did agriculture. So that's really what I'm watching right now. Can we see these things break out in the coming weeks?
We'll have more with Mike Swanson right after the break.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're speaking with Mike Swanson. Mike, will the wildfires in Australia affect the commodity markets because Australia is a major mining and commodity producer?
Well, if they do, it would only be to benefit them to the upside by suspending some of the, mining and energy operations in Australia. Copper, raw materials, and so forth. I have no idea if the fires are going to get out of control to that extent, but I would say if someone's worried about that, just avoid the stocks that are pure Australian plays. And other than that, it's not a reason to be negative on commodities. That's for sure. But I would also add that copper, another reason to be bullish on commodities is even though gold and silver at the moment are pulling back from where they were last week, copper stocks are not. Copper stocks are going up. For example, Southern Copper has broken out in the past 3 days. It's trading at a new 52-week high. Materials, copper, and energy giant BHP Group. It's not broken out yet, but it looks like it's about to. So there's a lot of interesting things happening across the board now.
The U.S. dollar, how big of a role does that play in commodity prices?
I think it's huge. So that's really, if there's if I can rank the fundamental reasons to be interested in buying commodities, I would put Middle East tensions towards the bottom of the list. And actually the U.S. dollar in the debt situation in the United States towards the top of the list and something related second. But the thing about the U.S. dollar is that the United States has $1 trillion deficit now. And we're not raising interest rates anymore. In fact, if anything, we're going to see a rate cut before the end of the year. At least that's a 50% chance the Fed funds futures market. But regardless, historically, gold and silver trade opposite to the U.S. dollar. And since October, which coincides with when the Federal Reserve began this new so-called repo, I call it new QE operation, the U.S. dollar index has been weak. It's trading down very slowly. And I think that's a trend also likely to continue for the next 10 years. A slow drop. I'm not expecting the U.S. dollar to crash by any means, but I think this is a reason to expect other commodities to go up in value also. And this also is the primary story of that 2000 to 2012 time period. It wasn't in the United States, it wasn't some mega demand driving the price of oil up and other commodities at that time, or gold and silver, but the fact that the U.S. dollar was weak during that decade. And that second factor that I said is related is that the Federal Reserve and its spokespeople have come out with interesting statements since October. So several times they have made an argument. Jerome Powell did it in the October press conference when the Fed lowered interest rates. And yesterday in the Wall Street Journal, this argument was made by various spokespeople who are talking to some reporter that works at the Wall Street Journal. If you want to, that's kind of becomes their mouthpiece. If to communicate with the investing public of the United States. But what the argument was that's so important is they claim that there's not enough inflation, that inflation is below a 2% target that they want to see. It hasn't been able to get above that target, even with rates so low and all these QE operations. And they wanted to get not only above the target, but to stay above it, which historically the Fed has said we don't ever want to get above 2% CPI inflation rate. Now they say they don't only want to get above it, but stay above it. The rationale given yesterday in the Wall Street Journal is that we've had inflation so low for so long that they fear that the American public is subconsciously trained to believe prices won't go up, and therefore they should just save and not spend and wait for prices to drop. And the argument is this is a danger to economic growth. I think this is nonsensical, but it doesn't matter what I think. It's what they are putting out there that matters. They're the ones that move monetary policy. But I take this as meaning that the Federal Reserve wants to create inflation. And if there's a dip in the stock market, a recession, even like what we saw in August last year, then I would expect the Fed to go to even more extreme levels to increase their QE and so forth. And all these things would cause the dollar to fall more and would cause commodities to go up more. I mean, they're stating they want inflation. So, you know, if you are a believer in the Fed, a lot of people, you know, you turn on CNBC or hear stock market commentators, they will say, hey, the Fed's got to put on the stock market, so don't worry about anything. Just hold SPY, hold Facebook, believe in Amazon and Tesla and Google, and just, you don't have to do anything. It's a put under everything. Well, I would tell people that hear that message, look, if you believe that, go for what will benefit the most if those so-called Fed puts are activated. It's gold and silver that will benefit the most. The mining stocks will benefit the most. Just look at what happened last year. The Fed lowered rates 3 times and GDX exploded and beat the stock market. And it's just going to be more things that are influenced in the coming years by that trend. And I think we haven't even seen that begun with oil, energy, and agriculture and other commodities, but that time will come. It's just, to me, is that time now, or is it going to be 6 months or a year from now? And I think it's very possible that moment is now quickly approaching, and all it would take is stocks like Exxon going through their 200-day moving average, and Exxon's at $69, and that 200-day moving average is at 71.56. So you're only talking about a 2-point rally. So that's how close we are. And unlike what happened in September, the energy stocks are not just crashing back down. So the potential is there. And when it comes to mining stocks, we're in an interesting moment where they're pausing. We saw a massive run up in GDX, which represents the big cap mining stocks. But for the most part, the juniors and the explorers and the small caps didn't move up that much last year. A few of them did. Stocks like Wallbridge, you know, went crazy. There's probably half a dozen that went totally crazy. But for the most part, most of them still have not gone up. They have market caps of 5 million, some with 3 million, hundreds of small cap mining stocks like this. And when money flows into that sector, almost every single one of them will have market caps of 25 million. So it's a massive opportunity. In bull market cycles, that's where the market caps get to. It's what happened around 2010 and 11. It's where things were from 2004 to 2008. And I think, you know, that's still plenty of time to get into these things and pick out the best ones. So it's a lot of opportunities out there, and I'm more excited in some ways than I usually am when I speak with you about different things in the markets because of what's lining up here.
We'll have more with Mike Swanson right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Mike Swanson. Mike, if low interest rates really did help boost an economy, then Europe should be booming because they have negative interest rates.
Well, there's a problem of the monetary policy, so-called pushing on a string is the term a lot of economists like to use it to make it understandable. But the problem comes when a country, or we can use a company, or even a person, for that matter, if you think about yourself out there in the audience, imagine if you had a credit card and you put $100 of debt on it. Well, that's no big deal. You can go, it's not going to stop you from using it again, going to a restaurant and buying a nice meal, or going on a vacation, spending $1,000. But if your credit card debt went to $15,000, and you make $50,000 a year, you'd get a little worried. You wouldn't spend as much money anymore. No matter how, even if your credit card company called you up and said, hey, we want to lower the rates, you're not spending your money, you're not using your card, you'd still be so much in debt, there's just not that much you can do anymore. That's where we are. So as I mentioned, the U.S. government has $1 trillion deficits now, but the global debt to GDP is also now at a record. The Chinese debt to GDP supposedly is over 300%. And Europe's debt to GDP in some of the countries is very big too. And it's simply that companies and governments around the world have taken on so much debt over the past decade that lower interest rates doesn't make them spend much more money. At least, it makes the government spend. They're not stopping, but not companies. They're not, the companies are still pulling back on corporate investment. They're not spending more, no matter how low rates get. In fact, over the past couple of years, the companies that started issuing more and more junk bond debt didn't use it to invest in expanding their operations, but used it to buy back stock, to make the stocks go up, to reduce the number of shares outstanding as a way to grow earnings instead of growing revenue to do that. It's because they don't see an easy way to expand revenue, not most companies. So we're in a zombie economy in a certain sense, although obviously the stock market action doesn't look like zombie action, although it is, because a pullback of any sort is not allowed anymore. So it's not been a normal stock market now for 10 years. And this is where we are. Why are we like this? I go back to Alan Greenspan. He would lower interest rates whenever he would get scared calls from Wall Street. He bailed out the long-term capital management hedge fund by lowering rates 3 times in panic. He created a stock market bubble. The internet bubble as a result. It collapsed. He lowered interest rates again. That created a real estate bubble. It collapsed in 2006, started to collapse. And that led to mortgage-backed securities going down the drain, which put Wall Street into bankruptcy. And instead of allowing the Wall Street banks to go bankrupt, which would have been brutal, but would have reset the system so we could have, in time, a sustainable economic growth path, a healthy economy, the government bailed out the banks, and the Federal Reserve did quantitative quantitative easing and bought back their mortgage securities. And the result of that was turning a Wall Street bankruptcy crisis into a government growing debt problem, which isn't a crisis yet, but I think will be one. And the Federal Reserve's answer, though, appears to be, we're just going to try to create enough inflation to inflate the debts away, perhaps in a controllable manner. That seems to be their hope. Now, their excuse is to tell us that the masses don't believe in inflation and therefore are pulling back on their pockets, and we got to change their mind by creating some. But I think it's a cover story to inflate away the debts in a slow manner, maybe 3%, 5% inflation rate over 10 years they may think can help inflate away the debts without a real debt crisis. But that's a gamble if that's really what their game plan is, because in the end, markets that seem to be fully controllable can one day run out of control. That's what happened in 2008, and are in creating a situation where you don't allow bear markets, don't even allow 25% stock market dips or recessions, simply builds up and balances until one day everything comes unglued. But I think they're trying to prevent that day with a plan of inflating away the debts. But regardless, it's a speculation on my part, and no one out there should make investment decisions based on someone's speculation or something that sounds like a prediction of the type I'm speaking about. Instead, they should stick to the charts and the trends, and those clearly are up when it comes to gold and silver, with a pause happening right now, but the long-term trend is up, and a potential turning point for energy and other commodities. And it doesn't matter so much the reason why, if my speculations of the reason are correct or not. It's position yourself with whatever the trends are. That's how you make money. There's other people got their theories. The Elliott Wave people got their theories about what's happening. Don't make decisions based on theories, but on what the trend is and when the trend clearly changes for you.
Mike, thank you so much for chatting with us.
Thank you. Great to talk with you.
My guest has been Mike Swanson from wallstreetwindow.com. If you have any questions for Mike or any of our other guests, you can send them to info@howstreet.com. Find us on Twitter @HowStreet, our YouTube channel, Talk Digital Network. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.